Okay, now that we have spotted the divergence at a key level, we've assessed the setup to make sure it meets all the criteria that we want it to meet to give us a high probability setup. Now it's time to enter the trade. So how are we going to enter into the trade? Now, for short-term divergence setups, we like to use limit orders to enter into the trades. This is better than waiting to pull the trigger on a correction manually, since the market can move really quickly at times, and that can cause you to miss trades. Plus, using a limit order, takes the thought out of the process. You've seen the qualified setup, place your order, let it go. Okay, and don't forget, we're waiting out the initial price move to qualify the setup. So we're waiting out that sharp price move to break the higher of the low between the points that diverged. That's what's going to qualify the divergence setup for us. Okay, then we're going to set our limit order in the 50 to 62% zone. This is the most common retracement of that initial swing. Now, some folks like to use the 62%, some folks like to use the 50%, some folks like to use in between. I know some traders that like to even use the 79% to get a better reward to risk ratio. Okay, obviously you'll get a better reward to risk using the 79%, but you're going to get less trades because not as many trades are going to retrace that deep. Okay, many times what you'll see me do is put my entry right in between the 50 to 62% zone. Okay, now if you use the 50%, just remember you're not always going to get a 2-to-1 reward to risk depending on your target. If you're targeting, and we'll talk about targets a little bit later, but if you're targeting the 127% extension, which is a standard target for what we call our simple objective divergence strategy, you're not going to get quite a 2-to-1 reward to risk ratio there. Okay, the 62% on the other hand normally gives you right at that 2-to-1 reward to risk. The 50% is not bad. You'll probably have about 1.5 to 1, maybe a little bit higher. And that's okay. That's okay. But if you want to stay with a 2-to-1, then you're going to want to wait out a deeper correction, or you're going to want to make sure you're only taking trades where you can target that second extension or another level of support or resistance based on maybe a higher time frame look. Okay, but for now we're just going to go ahead and keep it simple. We're going to set our limit order at where you choose from the 50 to 62% zone. Now, for higher time frame divergence trades, we can either use a limit order with a smaller trade size or use a smaller time frame setup to enter into the larger cycle. For example, if you're trading a 4-hour divergence setup, you may not want to use a stop loss that's large enough to get above the pattern. Okay, because the swings, obviously it's a 4-hour chart, the swing is going to be much bigger. Your stop's going to be much wider. So on those particular setups, what we do is we'll drill down and we'll do what we call the top-down trading that we just learned. We'll do top-down trading. We will mark off that 50 to 62% zone on the 4-hour, the higher degree time frame divergence setup. Then we will look for a smaller degree entry reason. Okay, a divergence on the smaller degree, smaller time frame, or an extension on the smaller time frame, and we'll use the stop on that pattern and the target on the pattern from the larger cycle. Okay, so we'll cover that in a moment. Now, we'll still look to enter, like we just said, we'll still look to enter in the 50 to 62% zone. However, we will then watch the smaller degree time frames for either a divergence or an extension entry. And that's talking about what we just talked about for the higher degree time frame. So let's go ahead and look at how we do this. Let's go ahead and pull up some charts and some potential divergence entries here. Okay, here's a chart, and I wanted to show this example for a very specific reason here. And this, folks might look at this and say, wait a minute, that doesn't qualify. That doesn't qualify. Price didn't come down and break the low. But this is what I want to show, and this is something we would qualify, and I'll show you the reason. We have price moving higher, MACD swinging lower. We have a divergence now. Price obviously did not come down and test this low. Okay, we didn't come down and test this low yet, but what we do have here is an extension. So a move that extends after a divergence, okay, does qualify as a setup. And when I say an extension, that's where we're looking for the initial decline here, Okay, we're looking for the pullback, and we're looking for that move to extend to that 162%. When this leg extends that 162%, that automatically qualifies this. All right, so now we're looking for a pullback and a continued move to the downside. So we would look at this as a qualified divergence just because of the extension. Extensions are very powerful. All right, so if we wanted to enter into this particular trade, we would just simply draw our fibs after that extension, 50 to 62% zone. Okay, so here's our 50 to 62% zone right here. Here's the 50%. You can see we came in and touched that initially. A little bit deeper here, just above the middle of that zone. If our order was in, the market would have brought us right into the trade and then continued here to the downside. And just to give a little bit of a preview of what we're going to cover here shortly, we'll put the extensions. I'll just put the divergence setup on here in my template. These are the extensions, the 127 and the 1618. Okay, these are the two targets we'll use for divergence trading, mainly the 127%. We'll target the 162% in very specific circumstances. Okay, so this would have qualified for a setup on this move down or rally back up in the correction, and for this leg would not have. Okay, this would not have qualified. Even though we continued to the downside, this wouldn't have qualified. Okay, so we're not looking at this because, oh, it worked out, so we're going to qualify it. You know, no, that's not how this works. Okay, this moved down in a three-wave cycle. It didn't extend, even though we broke the low here. Okay, on this pullback, we would not have entered into the trade. Now, if this leg would have extended, that would have been different. Okay, so if we would have had price here, and this would have extended down to that 162 and then pulled back, that would have been a different story. Okay, but it didn't. It just moved a simple three-wave structure right to about, I'm looking at equal legs, I believe. I apologize, I keep hitting the wrong buttons here today. But I would assume this moved right to the equal legs 127 area, because that's very common. And yeah. Okay, so we moved right to equal legs and then had this rally. So that would not have qualified. Now, here's a case of a smaller divergence that did qualify. The larger did not. All right, so let's take a look at that. And here you can see we have divergence. Now this is what I want to focus on right here. Price moving higher, MACD swinging lower. Look at the sharp price move right here. Okay, that broke through this low. Then we had our corrective setback. Then we had this corrective setback right here. Let's go ahead and measure that. Now what we would have done in that scenario was put the limit order in. Okay, put our limit order in right here. So when the market rallied back up, it brought us into the trade. And you can see it moved right down into the 127, stopped at the 1618, and that's where we found resistance and started to rally up. Now, this move right here, you might say qualified this larger divergence, right? Qualified this, it broke through this low. So is that qualified? What do you think? No, it's not. Okay, because this cycle is a three-wave cycle, and it did not extend. If we do the measurements on the entire cycle, it did not extend. It moved equal legs 127, and that was it. Okay, in order for this to qualify, it would have had to extend to the 1618, and it did not do that. Okay, another qualified setup. Price moving higher. MACD here is cycling lower. Sorry, it's hard for me to draw sometimes. Yeah, there we go. Cycling lower. Broke through. Nice sharp cycle. Broke through the lows. Now we would draw our Fibonacci retracement on this swing and we would wait for that corrective cycle with our entry 50 to 62%. Okay, and what happened? Absolutely nothing. Market did not make a 50 to 62% pullback, fell short, didn't get into the market, didn't get into the trade before it moved to the downside. Okay, and this will happen. It's going to happen. That's trading. Okay, but that's a qualified setup. You want to draw your fibs on this sharp swing, and this is where you want to place your order. Okay, so we're going to place our order in the 50 to 62% zone. Okay, you can use the 50, you can use 62%, you could use in the middle if you want. Okay, but place your limit order and let the market come up and bring you in. Okay, now let's say we're looking at, and actually I got the wrong chart up here, so let me get another chart. Well, let's just show this as an example first. This is just another 15-minute setup. We have price moving lower, MACD swinging higher. Again, a pretty sharp cycle here, and it extended anyway, so we would look for the potential of this. Oops, yeah. We would draw the fibs on this swing. We would have our limit order in. Now, in this scenario, we have a nice little confluence here as well at the 50%. Previous price resistance here and here. All right, so this is a situation where we might want to put our target, our order at the 50%. And you can see the reaction here initially, and a nice little rally right up to the 127%, where we again found another divergence right here. Price moving higher, MACD swinging lower, another extension in here. Oops. And you can see how the market, now this one did not quite at that point. This would have been a break-even trade. Okay, because even if you entered in here, you came down and tested this low, you would have got the risk out of the trade at that point, and the market would have came back up and grabbed that stop for a break-even before continuing on down. Okay, but that's trading. That's fine. That's trading. You're going to take break-evens as well. Okay, but the main point, limit order. So when the market comes down here, and you can see there's a pretty sharp move here. Okay, it brought you right into the market. Because look how quick this move was. Look at how fast this move was. This is a 15-minute chart, and look at that candle. I mean, this came into this level and just immediately bounced back up. Right, and that's why you want to have a limit order in. You don't want to have to try to make a decision down here. You know, the market comes down here, you're thinking, should I enter, should I enter, should I enter, should I enter, then boom, it's gone. It's too late. Then what happens? Now you see the market rallying up like this, and, oh, I got to get in. You pull the trigger to get in, you know, and that's fine, but it's not fine, excuse me, because now you have not a really good reward to risk. If you're coming right up on this resistance, okay, now in this situation it worked out. Obviously, you had a continued move pretty far up to the upside. But remember, just because the market can hit this level and then pull right back down. Okay, we can test this resistance and pull right back down. All right, so you don't want to chase the market. The last thing you want to do is chase the market. That is a very big mistake for a trader, is to chase the markets. Okay, so using limit orders to enter. Now let's look at a higher time frame setup. Now here is a British pound, and this is a daily chart. Now the reason I'm showing this is, yeah, we didn't break the low right here, but this is also, this is an extended move. If you go down to the smaller degree time frame, you'll see this right here is an extended cycle. From this low, the pullback, and then this decline is extended, so that qualified this as a setup. All right, so we have divergence here between the swings. We have an extended setup. So what we would do is we would place our Fibonacci here. Now, what we want to consider with this is, depending on where you're looking to enter, whether it be the 50 or the 62% or somewhere in the middle, we're talking about, to get above the high where you need to put this stop, is 520 pips. Okay, I don't think many of us want to use a 520 pip stop. You can, but it's probably going to be a pretty small trade size. Pretty small trade size. So what would we want to do? What would we want to do at this level? We would want to watch the smaller degree time frame, we would isolate this zone. Okay, we know we're looking for a potential turn somewhere in this zone. And we're going to look for a smaller degree time frame setup to enter into this trade. Now, unfortunately, I can't go back to the intraday time frames on this particular date. This was back in 2014, in March of 2014. But what we would look for here, we'd go down and look for a divergence setup at this level in this zone, okay, on the smaller degree time frame, say the hourly chart, or an extension, something to enter into the market with at this level. What we would do is we would use the pattern of that smaller degree time frame. We would use the pattern to place our stop loss. So say we had a divergence here, we had an extension here, we would put the stop just above that pattern, but we would still target. We would still target the 127% on this degree. Okay, so basically, and what I'll do is I'll just use the short position tool here. Let's just say we had an entry somewhere around, if we had an extension or a divergence in here that qualified, let's just put it right around there, just as a guesstimate to give us a little bit of a round figure. Stop just above that area right there, and then targeting down here near this extension would give us something somewhere around a 9-to-1 reward to risk ratio. Okay, a 9-to-1 reward to risk ratio, maybe using, maybe 100 pip stop or even a little bit less. Okay, instead of using a 520 pip stop. Okay, so that's the idea behind top-down trading, where we use the smaller degree time frame patterns to enter into the larger degree patterns, with a smaller stop loss giving us a really good reward to risk and allowing us a decent trade size because we can have a smaller stop. So remember, you have a regular trade size on this as well, with that 9-to-1 reward to risk. Okay, so these types of setups, while they don't always play out to the targets depending on how you manage them, because obviously you're going to want to lock in profits. If you have a 9-to-1 reward to risk ratio, you're obviously going to want to lock in some profits as price moves. Okay, but it's a much more effective way to enter into these patterns instead of using just a very large stop, a really small trade, and having to stay in the trade, for weeks or a month, for 1 or 2%. Okay, so and in the live service, you'll have a 2-week trial membership to the Forex Mentor Daily Trade Plan, and you'll see us use this method a lot in the service. Okay, so one of the good things is you'll be able to see us apply this in the real market.